Nationally, we've seen the performance gap shrinking between the top end and lower tier apartments, but in a handful of spots that gap persists, and Richmond is one such place. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Richmond update. First of all, Richmond is seeing some encouraging numbers on the jobs front. 14,000 jobs added on net over the past year, expanding the job pool 2.3%. And while you see some fluctuation in job growth levels over the past couple of years, the numbers are generally quite healthy. Now let's look at some apartment numbers, starting with occupancy. As of Q1, occupancy came in at 92.9%. Not a great number, and it was down 140 basis points year over year due to some sharp cooling in the seasonally slow winter months, and that puts Richmond 80 basis points below the South regional average. And rents, not bad, 2.7% growth in effective rents for new leases over the past year. That is a hair above the U.S. average. Nice quarter-over-quarter bump in Q1, up 1.9%. Now let's talk about that performance gap between top and bottom end apartments. As jobs come back, what we tend to see is a surge in demand in older, more affordable submarkets, and that helps narrow the performance gap between the top end submarkets and the more affordable areas. And generally, in most spots, the top end spots were the ones that recovered quickest. Now in Richmond, we're just not seeing that. We still see a very large performance gap. Richmond's most affordable submarkets continue to struggle. Here are those two spots that are struggling the most: East Richmond and South Side, Richmond's two most affordable areas. Occupancy still very weak in both spots, just under 90% in South Side after a sharp drop of 300 basis points over the past year. East Richmond, not a whole lot better, down 50 basis points year over year to 91.3%. Now let's contrast those numbers to Richmond's other 6 submarkets, and you see generally healthy occupancy rates everywhere else, all around 94% or better. Occupancy is still best in the 2 priciest submarkets, downtown The Fan and Hanover County, both around 96%, even after a little bit of softening over the past year. So what you see is that occupancy was dropping pretty much across the board in almost every submarket. It isn't a surprise to see occupancy easing in the higher rent submarkets, which tend to compete more with new supply and also with home sales. But it is disappointing to continue to see occupancy loss in those key, more affordable submarkets. So if more jobs can't get occupancy up in those 2 areas, it's not clear if that'll change in the next year. And the performance in Southside and East Richmond is very important for the Metro's overall numbers, just because there are a big chunk of apartments in those 2 submarkets. Overall, though, for Richmond, we do expect to see occupancy bounce back over the next couple of quarters, and we expect rent growth to remain around 2 to 2.5% on an annual basis going forward. And that wraps us up for Richmond. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.